Here is my list of the top 3 stocks that you should add to your portfolio today. Now, I've seen a lot of YouTubers cover this. I see a lot of articles on like the top stocks that you should buy. And to be honest, pretty much every single one is all wrong. They're all still covering AI stocks. Honestly, anything with any sort of AI or semiconductor chip stock is just absolutely wrong. You should not be adding those to your portfolio right now just because their valuations, guys, are so high. Why would you buy at the top? They're at the tippy top, okay? There's nowhere to go. Every bit of growth has already been factored into these stocks. You're not going to make a long-term return on them. You might make a short-term gain, sure, but you're not going to make long-term money on these things buying it at the height that they are today. And so my list, starting off at number 3, is Shopify. Their price to sales is low compared to their historical levels. Pretty average, though, in terms of tech companies right now. Their debt to equity is 10%, and thus their probability of bankruptcy is about as close to zero as you can get, so very safe in that term. They do not pay a dividend, but here's the thing about Shopify. They have absolutely smashed their last 4 earnings calls, beating estimates by ridiculous margins, and their projected revenue earnings growth is also incredibly high. You know, analysts are calling for prices of $82 a share and above next year, which is about 16% higher than it is today. So no, not a triple-digit return like these people are promising, but it will go up, and it will go up slowly. Slow and steady wins the race, you guys, in stocks. And I mean, there are just so many great reasons to add Shopify to your portfolio right now. It's actually crazy. I'm very bullish on this stock, obviously. Second in line is PayPal. Now, PayPal's valuation is super, super low right now. And I mean super low, with just a price to sales ratio of 2.4. which is, like I said, rock bottom compared to their price to sales history, and is about 5 times less than the average tech company's valuation right now, okay? If AI stocks are the top of the hill in terms of valuation, PayPal's the dead bottom of the valley, okay? Which is good because the reason it's so low is because of a lot of recent analyst downgrades. But honestly, even after the downgrades, they're still projected to grow at a rate of about 8% per year, which, yes, isn't amazing for a tech company, but you have to remember, PayPal's been around for a while, it's a mature company, it has a large market cap, so naturally it's not going to have the same growth rates as a lot of these younger companies, and I find PayPal's growth rate to be pretty similar to a lot of other larger tech companies, which it doesn't add up because it just simply doesn't justify a valuation as low as it is. Their debt to equity is 45%, which is about average, and like Shopify, their chance of bankruptcy is very, very low and basically zero. They do not offer a dividend, but given their super low valuation and close to average growth rate, I think this stock is absolutely oversold, and it's a very attractive deal at its current price level. And that brings us to stock number 1 on my list, and that is Ford. I love Ford. Ford's valuation is pretty average given its history, so it doesn't really look undervalued according to that metric, especially when you compare it to both Shopify and PayPal's valuations that are lower compared to historic levels. But what makes Ford a spectacular buy right now is its growth estimates. Okay, their EPS is expected to grow at a rate of 14% per year, and let me give you some of their rivals' EPS growth estimates. GM 3%, Toyota 2.4, Honda 6.1, Nissan 7.6. Ford's is double the next highest company. So, you know, it's under, and I think this is underestimated. I think these growth rate estimates are actually underestimated. I think they're going to be higher because we are seeing demand slow for EVs. Okay, the writing's on the wall. People don't really, want EVs as much as they thought they did. Demand for hybrids is heating up, you guys, and Ford has a 3-year head start now in the hybrid pickup segment, having released the F-150 hybrid back in 2021. Ram and Toyota have only just released their hybrid trucks this year, 3 years behind Ford. GM is planning on offering their hybrid truck next year for 2025, and Nissan they've only just started developing theirs. They only just got into a partnership to develop their first hybrid truck. So this let me tell you why this is a big deal, okay, for hybrid pickup trucks, is because trucks obviously make up a huge portion of Ford's revenue, and them being the first to make the shift to hybrid, when clearly that's going to be the new trend, just gives Ford a first mover advantage that I think is just totally understated right now. I mean, in fact, Ford actually had to pause orders for the Ford Maverick because there was so much demand for the truck. And I mean, it's pretty clear, well, not pretty clear, it's insanely clear that the people want a truck that's good on gas, and Ford is already out here selling them hand over fist. They cannot sell them fast enough. They have to pause orders. Meanwhile, other manufacturers are now having to play catch up. And some other things that are great about Ford: currently offers a dividend yield of 4.69% and has historically been a fantastic dividend stock. When you think of dividend stock, Ford is the first stock that you think of. But one thing actually that I found quite alarming about Ford stock is their debt to equity is, I didn't believe it when I saw it, but it's actually 300%, which is a bit of cause for concern. Even when you're dealing with a company like Ford that has so much cash, but they do have they have a good history of doing good with their liabilities. Their future growth means that they'll be able to cover these liabilities if they can meet or exceed the estimates, which they very likely will. Like I just said, I think it's understated, but all at the same time, I would like to see that debt to equity lower than 300%. It should not, under any circumstance, be more than 200%. But like I said, I think their future estimates and, those outstanding numbers that they're supposed to put up are going to more than make up for that risk. And on this note, though, their chance of bankruptcy is only around 2%. So just like Shopify, just like PayPal, it's so low, it may as well be zero. So, still pretty safe. Well, not pretty safe, incredibly safe. And all things considered, the valuations for Ford, the valuation's fair. They're leveraged out quite a bit, but I believe it's the growth projections that really make Ford a very, very strong buy right now, especially paired with its robust dividend history. So go take a look at those stocks. Please don't forget to drop a like, subscribe, and I will see you next video.